Hello, and welcome to another deep dive into the world of smart investing. Today, we're exploring a powerful strategy that's been making waves in the financial world: direct indexing. Whether you're a seasoned investor or just starting to build your wealth, this video is packed with insights to help you understand how direct indexing can supercharge your portfolio. So grab a coffee, get comfortable, and let's dive right in. First things first, what exactly is direct indexing? At its core, direct indexing is an investment strategy that allows you to own individual stocks that make up an index like the S&P 500 directly in your portfolio rather than investing in a mutual fund or ETF that tracks the index. Think of it as a personalized version of index investing. Instead of buying a pre-packaged fund, you're essentially building your own custom index, tailored to your specific goals, values, or taxes. Now you might be wondering, why would I want to own all those stocks myself? Isn't that a lot of work? Great question. Direct indexing has evolved with technology, and today it's more accessible than ever, thanks to advancements in robo-advisors, low-cost trading, and sophisticated portfolio management tools. But before we get into the how, let's break down the why. The key benefits that make direct indexing so appealing. Let's start with one of the biggest advantages: tax efficiency. When you invest in a traditional index fund or ETF, you're subject to the fund's capital gains distributions, which can trigger taxable events even if you haven't sold your shares. With direct indexing, you own the individual stocks, giving you more control over when and how you realize gains or losses. This opens the door to a strategy called tax loss harvesting, where you can sell stocks that have declined in value to offset gains elsewhere in your portfolio. The result? You could potentially lower your tax bill without deviating from your investment strategy. Here's a quick example. Let's say you own shares of a company in your direct indexing portfolio, and that stock drops significantly. You can sell it to realize a capital loss, which can offset taxable gains from other investments. Then, you can reinvest in a similar stock to maintain your portfolio's exposure to the index. This kind of flexibility isn't possible with a traditional index fund, where you're locked into the fund manager's decisions. Another major benefit is customization. With direct indexing, you can tailor your portfolio to align with your personal values or financial goals. For instance, if you're passionate about environmental sustainability, you can exclude companies with heavy carbon footprints from your portfolio while still tracking the performance of a broad index. Or maybe you want to overweight sectors like technology or healthcare because you believe they'll outperform. Direct indexing gives you that freedom to personalize without sacrificing the diversification that index investing provides. And speaking of diversification, direct indexing lets you enjoy the same broad market exposure as an index fund. By owning a representative sample of stocks in an index, you're still spreading your risk across hundreds of companies, sectors, and industries. It's the best of both worlds: the stability of index investing with the flexibility of individual stock ownership. Finally, let's talk about cost. Historically, direct indexing was reserved for high net worth individuals because owning hundreds of stocks required significant capital and incurred high trading costs. But today, fractional share trading and low or no commission platforms have democratized access. Many robo-advisors and wealth management platforms now offer direct indexing for portfolios as small as $5,000 or $10,000, making it accessible to a much wider range of investors. So to recap, direct indexing offers tax efficiency, customization, diversification, and increasingly competitive costs. But how does it actually work? Let's break it down. Imagine you want to replicate the S&P 500, which includes 500 of the largest publicly traded companies in the US. In a traditional index fund, you'd buy shares of a fund that holds all 500 stocks in proportion to their weight in the index. With direct indexing, you, or more likely a robo-advisor or wealth management platform, buy those individual stocks directly or a representative subset to closely mimic the index's performance. Here's the step-by-step process. First, you select the index you want to track, like the S&P 500, Russell 2000, or even a global index like the MSCI World. Next, you decide on any customizations. Maybe you want to exclude certain industries like fossil fuels or overweight specific sectors. Then, the platform purchases the individual stocks in the right proportions to match the index's performance. Sophisticated algorithms handle the heavy lifting, ensuring your portfolio stays aligned with the index over time, even as stock prices fluctuate or companies enter or leave the index. Now, here's where it gets really interesting. The platform continuously monitors your portfolio for opportunities to optimize. For example, it might identify stocks that have lost value and sell them to harvest tax losses, then replace them with similar stocks to maintain your exposure. This process can happen automatically, often daily or weekly, depending on the platform. One thing to keep in mind is that direct indexing doesn't mean you're buying every single stock in the index. For large indices like the S&P 500, some platforms use a sampling approach, where they buy a subset of stocks that closely tracks the index's performance. Now, you might be thinking, this sounds complex. Do I need to be a financial wizard to make this work? Not at all. Modern direct indexing platforms are designed to be user-friendly. You set your preferences, and the technology does the rest. Many platforms even integrate with your tax software or accountant to streamline tax loss harvesting and reporting. It's like having a personal portfolio manager without the hefty fees. We're about 2/3 through this deep dive, and I hope you're finding this exploration of direct indexing as fascinating as I do. If you're enjoying this video, please take a quick second to hit that like button. It really helps the channel grow. And if you want more insights on investing strategies, personal finance, and wealth building, don't forget to subscribe and ring the notification bell so you never miss an update. All right, let's keep going. To really understand the value of direct indexing, let's compare it to some common alternatives: traditional index funds, ETFs, and actively managed funds. Starting with index funds and ETFs, these are the closest cousins to direct indexing. They're low-cost, diversified, and designed to track an index's performance. However, they lack the customization and tax loss harvesting opportunities of direct indexing. If you're happy with a one-size-fits-all approach and don't need to optimize for taxes, an index fund or ETF might be the better choice due to their simplicity and lower minimums. Next, let's consider actively managed funds. These funds aim to outperform the market by having a manager pick stocks or time the market. The downside: higher fees, often 1% or more annually, and inconsistent performance. Studies consistently show that most active managers underperform their benchmarks over the long term. Direct indexing, by contrast, sticks to the passive, low-cost philosophy of index investing while adding flexibility and tax benefits. Another alternative is individual stock picking. Some investors love the thrill of selecting their own stocks, but this approach is riskier and time-intensive. Direct indexing offers the diversification of an index while still allowing some personalization, making it a middle ground between stock picking and broad market funds. So how do you decide? It comes down to your goals, portfolio size, and comfort with technology. If you want low-maintenance investing, stick with ETFs or index funds. But if you're looking to optimize taxes and align your investments with your values, direct indexing could be a game changer. One tip: work with your financial advisor or tax professional to maximize the benefits. They can help you integrate direct indexing into your broader financial plan and ensure you're taking full advantage of tax strategies. We're at the Who Should Consider detailed list. First, direct indexing is a great fit for investors with taxable accounts. If most of your investments are in tax-advantaged accounts like a 401k or IRA, the tax benefits of direct indexing won't apply, since those accounts already defer taxes. But if you have a sizable taxable brokerage account, say $100,000 or more, direct indexing can help you save significantly on taxes over time. Second, it's ideal for investors who want personalization. Maybe you have strong ethical convictions, like avoiding companies involved in tobacco or weapons manufacturing. Or perhaps you're bullish on certain industries and want to tilt your portfolio in that direction. Direct indexing lets you express those preferences while staying diversified. Like any investment strategy, direct indexing has its risks. First, there's tracking error, the possibility that your portfolio won't perfectly match the index's performance due to sampling or customization. While platforms aim to minimize this, it's something to keep in mind. Second, direct indexing can involve higher costs than traditional index funds. While trading fees have dropped, some platforms charge management fees for direct indexing, typically 0.2% to 0.5% annually. Compare this to index funds, which can have expense ratios as low as 0.03%. Finally, there's the complexity factor. Even with automation, direct indexing requires some understanding of your portfolio's mechanics. If you prefer a completely hands-off approach, a traditional ETF might be less hassle. As technology continues to evolve, direct indexing is poised for even greater adoption. With more platforms offering fractional shares, zero commission trading, and AI-driven portfolio management, the barriers to entry are shrinking. We're also seeing growing interest in ESG investing through direct indexing. As more people prioritize sustainability and ethical investing, direct indexing allows them to build portfolios that reflect their values without sacrificing market exposure. Plus, advancements in AI and machine learning are making tax loss harvesting and portfolio optimization even more precise. So, there you have it, a comprehensive look at direct indexing, from its tax advantages and customization to how it compares to other strategies. Whether you're looking to save on taxes, align your investments with your values, or take more control over your portfolio, direct indexing offers a compelling option for modern investors. What do you think about direct indexing? Have you tried it, or are you considering it for your portfolio? Drop a comment below and let's start a conversation. I'd love to hear your thoughts. Thanks so much for watching. If you found this video helpful, please give it a thumbs up and subscribe for more investing insights. Until next time, keep building your wealth smarter. See you in the next video.